Hi, I'm Maria Dawes, Portfolio Manager at Capstone's Private Wealth Team. And with me today is once again Janet Kinsing, my fellow Portfolio Manager. So, welcome, Janet.
Hello, Maria. It's back to just the two of us, it seems.
Yeah, so hold that thought though, because we actually do have an announcement on that front, which we're going to save till the end of this update.
Wow, such suspense.
That's right. So, Janet, joking aside, what are we talking about today?
So at our last update, we had Glenn Murray, Chief Investment Officer and President at Capstone, giving us a quarterly rundown, which was great, very in-depth and insightful. And so I thought that today we could start things off with a short summary on bonds.
Right. So, the last time just the two of us spoke together without Glenn, we did do a general primer on stocks. So, switching to bonds does make sense.
Yeah, and most of us, me included, tend to follow the stock market indices more than anything.
Yeah, I think we're all guilty of that.
Yeah, and but bonds are interesting too, and it's funny because they get a lot less attention than stocks. But bond investors tend to be more sophisticated. It's said that they understand the path of the economy better. They'll weigh inflation and growth expectations along with supply and demand factors, so a bit more comprehensive. Of course, in these unprecedented times, with the constantly changing inflation expectations, combine that with all the central bank intervention, it is very difficult. But right now, what we do know is that rates are going to be very low for a very long time, let's say 2022 until at the earliest. And when we look at 30-year yields and think about this is what you would get paid if you held a bond for 30 years until maturity. You're looking at about 1%. So these low rates are intentional amidst the pandemic and are in part dictated by our central bank, the Bank of Canada, who has implemented this quantitative easing, or what we call QE program. Um, and this QE program, basically long bonds are purchased in the marketplace. And what this does is effectively remove the supply of existing bonds from the market. And that makes the remaining bonds more valuable. And that will boost the existing bond prices while at the same time depressing current yields.
So let's just stop there a moment because I think you hit on a good point that is worth fleshing out, and it's the interaction between interest rates and bond prices. So bond prices and interest rates move opposite each other, meaning that as interest rates go down, bond prices go up. If you think about it a bit, that makes sense. If the interest rates are trending down, then the bonds already in the market, the ones that are at a higher interest rate, they become more valuable.
Yes, and not to throw a spanner into the works, but Maria, I know you do like to talk about duration as well. So why don't we go there?
Right. So duration is basically a measure of a bond sensitivity to interest rate changes. So if a bond or a bond portfolio has a short duration, then it's less sensitive when interest rates change. Now, whether that's a good thing or a bad thing really just depends on the direction and magnitude of those changes.
So I guess now it seems like I'm asking all these questions, but anyways, maybe we can talk a little bit about our fixed income pool and how that has fared in that regard, because our fixed income pool is actually the only pooled fund at Capstone that is truly a hybrid, meaning that it's a combination of both non-traditional and what we have there is infrastructure, factoring, some unique private debt opportunities, and then we also have around 30% right now in more traditional bonds. And so while we have been less affected by the non-traditional side, which is still plugging away, our traditional side will be more strongly affected by all this bond buying news.
Right. So intentionally, we've designed the capstone fixed income pool to have a fairly short duration. And this means it won't fluctuate so much when the interest rates change, especially compared to the bond market as a whole. That being said, though, now that we're in a lower interest rate period for longer, it's taken more time for the traditional side of the fixed income pool to recover as the market strengthens. So, having said that, though, so far in July, the fixed income pool is up 1.12% for the month. So that's been pretty positive news.
Yes, it is definitely very nice to see that. So there is so much more that we could talk about when it comes to bonds, including different types of bonds, different spreads that we look at as leading indicators and all that kind of thing. But I think it's better that we wrap things up now. And Maria, maybe you can have the honor of sharing our special announcement.
Sure, I'd love to do that. So we have our first guest speaker who is not Glenn, who will be joining us the next time we do a video update. And he is actually a face that is probably familiar to many of you. This person has over 30 years of investment experience. And prior to that, he used to put people to sleep for a living. So there's one clue. He also has 3 grown children who are adopted from Kazakhstan, and he's been with Glenn and me since the very beginning of Capstone.
Okay, so not Glenn, but someone who's been at Capstone a while, and it's a he. So I'm not sure if anyone has any guesses, but you will have to stay tuned. So yeah, very mysterious. And with that, we hope that you stay well and stay safe. Thanks, everybody.
Thanks. Bye.